participate in this. I work with the company Premium LLC. We kind of do soup to nuts of captives insurance, and I've spent the last 25 years working with captives and doing insurance defense work, and so hopefully I can bring a little information here that's a different way to look at insurance and how captive insurance might be able to be a solution for your clients. One of the things that we do as professionals is our clients come to us looking like this, and usually that's because they've had this happen to them. They've lost money, they have problems, they need some help, and our job typically as professionals, accountants, lawyers, whoever we are, is to help them regain as many dollars as they can and protect what they have. And insurance is just a tool, captive insurance especially, is a tool that we can use to help them both protect their assets and hedge against problems that they may have. So we want to talk about a couple of things today. We want to talk about some general insurance concepts. We want to look at sort of the taxation, how it applies to a captive insurance. I have just put some numbers and a financial example, and then questions that we often get. So let's think about insurance for just a minute. And again, this is a bit different way to look at insurance, but insurance really is made up of four things that are that each insurance policy has to have, and the IRS looks at these things, by the way, when they try to decide if a particular insurance policy is really insurance. So let's look at each one of these. Fortuity is kind of what you'd expect, that the risks in an insurance that we're insuring can't be certain. In other words, they can't be past losses. We can't insure losses we know are going to happen, so you can't insure stock market losses or gambling losses. We have to insure things that are outside of our control. We can't insure things that we create by failing to act or by doing intentional actions, and that's why all insurance policies have exclusions in them that they will not insure intentional actions. In many states, you cannot insure punitive damages, which are damages that come from intentional or egregious acts. So this fortuity is one of the important things. You can't insure, buy insurance today to cover an earthquake that didn't happen yesterday. It's just common sense. But sometimes we see clients who want to kind of go crazy here. We have to insure something that's an insurable interest. For example, you can't insure the life of someone you're not related to in business or in a family way. You can't insure your neighbor's house. You can insure loss of some bad thing that happens to your supplier because you're relying on that supplier to give you goods and material to do your job. So we have to have an insurable interest in what we're looking to insure. And insurance is typically indemnity. We're looking to put somebody back in the same position that they were before or to compensate for some loss that they'd suffered. And this is where this risk shifting and risk spreading, this is where the IRS really focuses a lot of their attention to try to figure out what if there is risk shifting and risk spreading. So the idea here is very simple. When you take a risk and you buy an insurance policy, you're paying some other entity to accept your risk, and they have to have the ability to do that, and then that other entity, typically the insurance company, has to spread that out over a large number of people or entities or risks so that they are equalizing the loss for everyone. Now that's the idea, and the IRS and insurance companies like to talk about the law of large numbers, which is essentially the idea that you have to have this big pool of risk in order to have insurance. But that concept has been challenged successfully with captives, as I'll show you in a minute. But still, the idea of risk shifting and risk spreading is an important concept that we have to meet. So there are lots and lots of things that could be insured out there, but there are really not very many companies that sell a variety of insurance policies. Most of your clients probably have two kinds of insurance policies. They have probably some kind of a general liability policy, which has a whole number of exclusions. and may or may not cover risks of their business, and they probably have some property policies which probably also have a number of exclusions, and more importantly, even the policy that might have $2 or $3 million limit has sublimits where you may only have $25,000 of coverage, for example, for valuable papers that might be in the office and so forth. So one of the questions is, well, why aren't more things insured that are real risks to a business? And that's an interesting question. And it really goes to the issue of control. As insureds, we have almost no control either over the kind of insurance that we're going to buy, which means you can't go to the insurance company and mostly and negotiate some kind of special coverage. Typically that is not available. And the other thing we don't have control over is the premium. So this brings us to the next concept here, which really we want to talk about premium for a minute and how the things that drive premium. And I want to use an example here of a particular market that is very discrete, so it's easy to see how the trends affect it. And this is the medical malpractice market in the United States for in the last 25 years of the last century. So the idea here is that we're all taught as insureds that premium relates to losses. More losses, everybody pays higher premium. But this graph suggests that's really not true. The top line is the direct written premium, so this is the dollars per doctor in normalized dollars. And you see that the premium really jumps around quite a bit, and the bottom line is the actual losses paid per doctor in the same normalized dollars. And you see there's really not a lot of variation on that line, certainly not the kind of variation that we see the volatility in the premium. And to make the matter more interesting, this information comes from the Doctors Company, which is the largest medical malpractice insurer in the country now. And this is just for California, again, for the same 25-year period. And the blue line is their claims, and the red line is the is the claims rather, and the blue line are the amount paid. So you see, there's just no connection here really between these issues. So if you looked at this in a kind of interesting connection, you really see that the premium is not linking to the claims in this same period. But if you look at the stock market for the same period, so here's the last 100 years, the yellow part is that same 25-year period, what you find is some pretty interesting things, because if you start to look at the stock market, premium is inverse to the actual market return. So as the market dropped in the mid-70s, a year or two later, premium spiked. And again, as the market dropped in the mid-80s, there's a large spike in premium a year or so later associated with that. And as the market peaked in the early 200s, premium came down significantly. So the truth of the matter is that capital markets drive both the kinds of coverage that are available and, in large part, the amount of premiums that are paid. So the real question here that we should be asking ourselves as professionals is, how can we really help our clients get control both of their risk and the amount of money they're paying to cover that risk? And captive insurance provides an attractive answer to that question in a number of cases. So we'll talk just a minute about some basic captive kinds of things. Captive insurance is the definition of it's very simple. It's just insurance that's controlled or held captive by the insured. Typically, that means that the owner of the company business also owns the insurance company and pays premium to the insurance company. That's a very simplistic view of what a captive is. Captives have a number of advantages. We've talked about control of both the kinds of insurance and the premium dollars to a large extent. They also allow a lot of other kinds of risk management tools to be put in place specifically for that client. Typically, a client who owns a captive becomes very much more interested in watching their risk, and they become invested in it in a large way. Because you're taking premium out of the operating business and moving it into a separate corporation, you're also getting a lot of asset protection in the event of an adverse effect in the operating company. You now have a pool of funds separate from the operating company that are available. And there's some estate planning opportunities. There's some tax saving potentials. And the bottom line is there's just a lot of control that a captive allows a business owner to have over things that he didn't have control over before. The kinds of coverage that we're typically looking for are kinds of high severity coverage that don't happen very often. These are the kind of things that business owners just get used to living with, and they'll just say, well, these are the risks of my business. And the reason they'll say that is because they either can't buy the insurance to cover that particular risk, it's just not available, or if they could find it, the price of it is so high that they just can't justify it. So an event that they expect to happen once every 10 years, but it costs them $100,000 a year to insure, that's just a lot of money for something that isn't going to happen frequently. So captive insurance is a good solution for that, because if the event occurs, they can make a claim. If the event doesn't occur, they can take profits out of the company.
Excuse me, Jeff, do you have, Jeff, just Damien here, just one of the questions that came through would you have some examples or an example of this low frequency, high severity situation that you were talking of?
I do, and if you give me just about 2 slides here, I think we'll get right to it, because I do have some examples.
Perfect, Jeff. Thank you.
The idea here is, again, that at the end of the day, the captive can be done and closed, and the shareholder of the business takes the money out. And here is where we get to our coverages examples. And again, the captive can create very custom coverages. Here's just a very partial example or list of types of coverages. We've had clients who've insured their supply risks. I worked with one, a sports drink company, and they were very concerned. Apparently France outlawed sport drinks, so they were very concerned that other EU countries might do the same. They created a regulatory risk insurance policy that should their product be outlawed or significantly limited in some way by a government, that they would be able to have a fund available to either fight that regulation or take care of expenses of reallocating product and so forth. We had another way that you can use this. Again, we had a client who is furnishes a dairy product, yogurt. They have $2 million worth of product on their premises at any given time. When we looked at their $5 million insurance policy, they had a sublimit of on-premises product, finished products of $250,000. So clearly inadequate. They insured additional, their captive insured the product on premises for an additional amount. We have a roofer. This guy does commercial roofing and multi-unit complexes. When we sat down with him and asked him what keeps him up at night, he said that the thing that really troubles him the most is that when it doesn't rain, he has no business. So we created a weather risk policy, a drought policy, if you will. So in years where he can demonstrate a drought, and when his income goes down, he can make a loss of earnings claim against his insurance coverage. So these are just some of the kinds of coverages that you can do. Again, our job is to be very creative as we work with you and with the owner of your client in finding those risks and figuring out if they're insurable, and if so, how we can insure them. So let's talk about the taxation part of this for a minute. The taxation piece is for smaller captives is very advantageous. In 1986, Congress passed the Internal Revenue Code 831B. 831B says that if you have a small insurance company, which they define as an insurance company that has less than $1.2 million a year in annual premium, so a small insurance company does not pay tax on its premium income. It only pays tax on its investment income. And you can imagine that the IRS didn't really care for that very much, and they actually fought against it for a number of years. But in 2002, after losing a number of court cases, they finally conceded that they were going to have to live with captive insurance, and they issued 3 revenue rulings that have become effectively safe harbors. The first one says if you have one owner of a business and that owner of the business, of that one business, also owns a captive, then the premium paid from the business to the captive is deductible to the business if the captive insurance company has 51% risk unrelated to that business. And there are a number of ways to accomplish that. The easiest is to use a reinsurance vehicle that we'll talk about in a minute. The second revenue ruling says if the owner of that business has 12 related companies, then all 12 related companies can create a captive, and each of the 12 can deduct the premium that they're paying into the captive. This would be real useful for real estate owners who have multiple entities that own real estate, or restaurateurs who have multiple restaurants held in separate corporations. Or the example the IRS uses is a professional service business that has offices independently incorporated around the country. The third IRS safe harbor is the 7 unrelated companies. So this would be a group of physicians that otherwise are separate in practice. They come together and they form an insurance company. Or it could be a group of companies in the same industry who come together to form a company. So 7 of those, the IRS says, is sufficient to create an insurance company. These are safe harbors, and we can be a little more aggressive in some areas, but if you comply with these, then the IRS is already on record as saying you're going to be fine.
Excuse me, Jeff. A good question's just come in. With the unrelated companies, do they have to be in the same industry, or is that what you see most given that we're insuring against a particular incident?
They do not need to be in the same industry, and although it's common that they are, simply because the owners have something in common and they understand each other's business. But we've seen people talk about this who are neighbors who otherwise are business associates and are familiar with each other's business, and they can come together. So it does not need to be related necessarily, or the same business or business risk. This is a very simplistic diagram now of what this might look like. So our owners of our operating company, our business, they're going to now pay up to $1.2 million a year to their captive. Done correctly, the business gets the deduction for the $1.2 million. The captive insurance company does not recognize the $1.2 million in income. And so this is kind of the way the unrelated risk works. Behind the captive, there's a pool or a reinsurance vehicle. Again, we'll get to that in a minute. But that allows that 51% unrelated risk. This is a simple diagram of the 12 related insureds. It's, again, very simplistic, and each of the operating companies would have a separate policy or policies. Together, they would pay premium that would total or not exceed $1.2 million. And likewise, if you had your unrelated insureds, this is, again, a simplistic diagram of what it might look like. Again, each of the operating companies would have separate policies that would have a separate premium totaling not more than $1.2 million. So we're trying to get to a financial example. Here in California, we're very fortunate. We have the 13 1/3 tax rate. We pay almost 50% in income tax. So you can put your own state rate in there, obviously, but here in California, if you at that tax rate, if you're putting $1.2 million away per year, you're saving $598 in taxes every year. And like we say, at the end of the day, if the least creative thing to do is to close the captive, liquidate the stock. The shareholder gets capital gain treatment, deferred obviously for a number of years. But many of our clients look at another option or other kinds of liquidation. In fact, you don't have to liquidate the company. You can surrender your insurance license. You now have a company that has probably $10 or $15 million in it that can go off and do other things. Other people retire, but the point being, the captive is a C corporation, and once it surrenders its insurance license, it's just like any other C corporation with a substantial amount of capital in it, and you're the owner of it can do whatever they could do with any other C corporation. Another very creative way to plan the end game for your captive is to actually use it as a estate planning vehicle. And under this type of scenario, the operating company pays the captive, but the captive is owned by some type of a estate planning vehicle or trust, a LLC, a limited family partnership, whatever that is. And now as profits are moved out of the operating company into the captive, they're also moved out of the owner's estate and transferred to the owner of the captive, the children, or whoever the beneficiary of that is. We've seen this, we've had clients who've done this by creating an LLC that owns 100% of the captive, and then the children's trusts own the LLC in proportion. The owners of the business manage the LLC, and we've been able to do it in such a way so that the trusts only contribute a few $1,000s of capital. The rest is loaned into the LLC, so there's no gift tax return filed even at the outset. So this can be a very powerful planning tool if it's appropriate for a client. Obviously, this is optional. We don't have to do this, but it's worth exploring. If we do use this as a estate planning vehicle, you've now got your ultimate deductions up to just almost the amount you were paying in premium. So that's pretty powerful. Here's our financial example. This just kind of puts some meat on the on the bones, so to speak, here, so you can get a sense of how this plays out in actual dollars. So when we create a captive, there's 3 steps that we use. The first one is we create a written business plan. We sit down with you, we sit down with your client, the owner of the business, we identify their risks, we look at their existing insurance, and we come up with a written business plan. It includes not only the risks that we're covering and the types of policies that we'll be issuing and the expected risks that might be or losses that might occur within that policy. It also includes planning of business structure, who's going to own it, who's going to run it, those kinds of things. Once we're satisfied that that business plan meets the owner's needs, then we go to an actuary, and they do an actuarial review. They take the assumptions that we have made about the company and the business and the insurance, and they turn those into projected losses, numbers, premiums, which is one of the big things we're looking for. So the actuary actually sets the premiums with our input, and then they do a 5-year pro forma, and that becomes the sort of economic side to the business plan. Once we have those documents, then we do the application to become an insurance company in the location or state that we want to do that in. Most of our clients are using U.S. jurisdictions. We have a number of clients in foreign jurisdictions, but you can get a lower, it can be slightly less expensive to do that in a foreign jurisdiction. It also becomes a little more complicated for tax purposes, and most of my clients end up deciding that the benefit of going foreign is not worth the hassle. So most of them are here in the U.S. So we'll apply to the state. We do all the corporation documents. We draft all the insurance policies. we create the actual application itself, and that goes off to the insurance department. There are about 30 states in the nation that have captive legislation on their books, but in selecting a domicile to put your captive insurance company in, that's just really the first question, because what you really need is regulators who are very understanding of how a captive works and the kind of unusual needs that a captive has. And there's probably half a dozen states in the country that currently are very welcoming to captives. We currently like Montana because the regulators there are very friendly and very easy to deal with. One of the first captives I put up there in Montana, they actually changed the law at my request. So I called the insurance department. The head of the captive division actually answered his own phone. I told him what I needed. He said that was a really good idea and that he would approach the legislature in the next session. And in fact, the law was changed to accommodate my client. So you got to love a regulator that'll do that. So we found them very friendly, but Utah's a good state. Delaware currently is very active in this. District of Columbia is welcoming to captives, and there's a few other states that are also of interest. So once that application's done and the insurance company is organized, then you have to manage it. State law does require that you have a local approved management company. They have to provide an office in the state. You need to have a local director on the board of directors. The management company maintains all the books, does the bookkeeping, prepares annual reports that have to be filed with the Department of Insurance. Captives are audited each year by an outside audit company, and the manager coordinates that. Captives also must be reviewed each year by an actuary, who certifies that the reserves are adequate. So the captive manager facilitates that. So these are things that happen that our company provides. There are other captive managers that do the same thing. The cost for this, and again, we're headed towards some kind of a financial example here. So the cost for this, the setup fee is about $75,000, and that includes the business plan, the legal fees, the actuary fees, the filing fees, and everything up to the licensing of the insurance company. Then the ongoing cost is somewhere between $50,000 and $60,000 a year, and I'll show you the breakdown of that at the next slide. If that captive needs to take 51% unrelated risk and they're using this reinsurance pool, the pool has to be an insurance company and it retains 5% of the risk, so it retains 5% of the premium, so that's really an additional cost. And in most jurisdictions, $250,000 is the minimum capital requirement. Some jurisdictions require more, but most of the jurisdictions that we deal with, Montana, Utah, and so forth, they all have that minimum capital requirement of $250,000. So here's the ongoing annual expense. The management company runs somewhere between $25,000 and $40,000 a year. Our company is currently at $30,000. The actuary typically is going to cost about $7,000 a year. The audit's going to run $5,000 or $6,000. The income tax filing is going to be about $2,500. The audit firm that we're currently using, if they do the tax return after they do the audit, they're charging, I think, $700. Premium taxes are going to be about $5,000. Insurance companies do not pay state income tax. They pay state premium tax. Premium tax is a percentage of the gross premium that's paid or collected by the insurance company, and it varies widely by state. Montana is 0.4%. California is about 3%. But Montana is 0.4%, but a minimum of $5,000. So there's a minimum premium tax there. And then again, the reinsurance expense can be zero if you don't need the pool or to have that 51% unrelated risk, or it can be as high as $30,000, which is that essentially 2.5% of the total premium. When you look at these expenses, and they are, there's significant expenses, no doubt, but when you look at the expenses as a percentage of the actual income to the company, they're well within what anyone would consider reasonable overhead charges. So if you're putting 1.2 million a year away, your overhead's running about 7%. If you're putting $500,000 away in premium, your overhead's running closer to 13%. So these are reasonable kinds of overhead costs. So all of that is background now, because what we want to do is talk about our kind of financial examples. So with that background, we're going to assume that a company is going to pay $1.2 million a year in premium. We're going to assume they're going to run their insurance company for 15 years. We're going to assume they've paid their $75,000 startup fee, that they're paying $80,600 a year in premium. We're going to assume the California rate of 49.8% in combined income tax. We're going to assume a federal, a capital gains rate of 20%, because certainly in California, anybody who's liquidating this kind of money is going to want to move to Nevada or some other tax-free state for a year or two. We're going to assume a 4% growth rate on their investments. And so with that, if you did this without an insurance company, so if you just took $1.2 million a year out of the operating company and you put it in a savings account, you'd obviously pay tax of about $598. You'd have after-tax income of $601. You'd have no expenses, and you'd have after-tax growth at 4%. And at the end of 15 years, you'd have $10.7 million in the bank. If you did that exact same thing with the captive, now you still have the same starting balance, or in this case it would be capital. You pay $1.2 million in premium. Now you're paying no tax. The insurance company is paying expenses, including that one-time $75,000 expense in the first year. It's growing at 4%, and at the end of 15 years, you now have $19.7 million. So just to put them kind of side by side, with the captive, you got $19.7 million. Without the captive, you got $10.5. But of course, without the captive is after tax. So if we now pay our 20% capital gains, you're still over $5 million ahead at that point. Now, we have not talked about claims, and to the extent that the captive have claims, that would reduce, obviously, the amount of the return. On the other hand, the owner would have gotten claims that he or she had paid, so they would see the funds coming back as a claim, not as tax advantaged, obviously, but still not a loss. So here we have, these are questions that we typically get. So let's just kind of talk about these, and then we can have time for any other questions that folks may have. The pool becomes something that's very important to understand how it works, because if you're the company that needs to have that 51% unrelated risk so that you can get the tax deduction, the pool is the best and easiest way to do that in most circumstances. So your client, our insured, pays money to his captive, and the captive buys a reinsurance policy from the pool where they send 51% of their risk to the pool, and it costs them 51% of the premium, $612,000, because we're assuming the $1.2 million. The pool has a series of captives that are all doing the same thing, and then what the pool does is it turns around and reinsures itself. It's called a retrocession in the insurance world, but it reinsures the risks back to the captive. But the risks have now been homogenized in the pool, so the risks going back to the captive are now the shared risks of all the insureds in the pool. So we're trading dollars. The pool is keeping that 5% of half the premium, 51% of the premium, but the rest of the dollars go back and remain in the captives. In fact, what really happens is the dollars don't actually leave the captive. There's a balance bill that's sent from the pool to the captive that's that $30,000, so the cash stays in the captive, but by signing the reinsurance agreements, the captive has accepted risk from the pool. So in this way, we're able to move money into, or not money, but we're moving risk and sharing it amongst the captives. Now these captives, obviously everyone in the captive, every captive owner understands that if you have to make the claim, you do, but the characteristics of the policies are all very similar, where these are very infrequent kinds of claims that are going to come up. So everyone's pretty comfortable that we're not going to have one captive that has regular claims and others that aren't. So you'll get an occasional claim in the pool, once every 10 years, every 5 years, something like that, but it's a very limited thing. Now, one of the things that's happening around the country is that people are using cell captives or series captives. So let's talk about that for a minute, because it's a specialized version of what we've talked about before. So here's our diagram. We have the shareholder, he has an operating company, and he's paying premium to the captive. In the cell captive situation, what happens is the owner of the business does not own the captive. There's a promoter or someone else that now owns the captive. That cell captive, sometimes called a sponsor or sometimes called a core, is a insurance company that's licensed in a state that's now owned by a third person. And for a fee, the promoter now creates a cell or a subdivision within his insurance company that relates to the owner of the operating company. So when the cash comes in from your client's business as premium into the cell captive, it's assigned by a bookkeeping entry to an individual cell, and it stays there until it's liquidated according to the terms of the agreement. Now, if you have a client that is involved with this, what you're going to need to do is make sure that they understand that agreement very carefully, because the money is actually not in a company owned by the owner of the business. So, and the only thing that gives them access to it is a very lengthy and very complex agreement that the owner of the business signs with the owner or promoter of the captive. So if you need us to look at something like that, we can do that, but it's been my experience that that document really doesn't get reviewed carefully enough, and there's usually a lot of fine print in there that really needs to be understood by the business owner before sending millions of dollars to the cell captive. Cell captives have, like most things, good and bad. They're faster to create a new captive because the insurance company already exists. All they're doing is creating that cell. It usually has reduced capital requirements because again, the company's already licensed, and the amount of capital that each cell is required to have is simply agreed upon between the business owner and the owner of the captive. And there may be some reduced expenses due to overhead sharing. In my experience, that has been largely illusory because the reduced expenses that you might save, for example, by sharing an actuary or sharing a audit, get eaten up with fees charged by the promoter who owns the insurance company. But that's all driven by the agreement, and so one of the reasons why you have to look at that agreement carefully. There may be, because of these reduced expenses, there may be a reduced break-even point, but that, again, that has to be looked at in each case. You do lose control. You do not own the captive, so you're bound by what the owner of that captive, the promoter, says the rules are, and that's all set out in that agreement, which is why, again, that's so important. Typically, if you look at this as at the expense load as a percentage of premium paid, the expense load as a percentage of premium is often higher than if you owned your own captive. So I encourage you, if you're helping a client sort through whether this is a good idea, look at that expense load as a percent of premium compared with what he might be able to get if he owned his own captive. And as I said, that the contracts between the sponsor and the cell are very complex. They should be reviewed by a lawyer or someone who really understands that. And again, we can help with that, and we'd be happy to do that. Let's talk about how investments work inside a captive. Obviously, just from a kind of cash standpoint, the biggest investment that most captive owners look at is that they have tax savings, and that's essentially an immediate return on their investment. As far as the cash in the captive, it's any prudent investor, any prudent investment is the standard. So if a prudent manager would decide that's a good investment, then that's a fair investment in the captive. So captives can use higher investment advisors. Many of our clients use the same investment advisors in their captive that they use in their other business or for their personal accounts. There is a limitation in captives that long-term investments are typically not suitable, certainly in the early years of the captive, and the reason is we have to have a liquid pool of funds that are available in the event of claims. Liquid means not cash, but easily assets that are easily able to be liquidated, so stocks, bonds, REITs, anything with a ready market. As the captive matures and as there's more profit or surplus in the captive, then you can take a longer-term view and maybe make some longer-term investments. Most of our clients are very concerned about control. They not only want control over the business and the risks of the business and see the advantage that a captive gives you there, but they want to maintain control over the captive dollars themselves. And this is where, again, having an independent captive, not a cell company, is an advantage. In a captive that your business owner, your client owns, they elect the board of directors. They can be the sole officer if they want. They can be the sole signatory on the bank accounts and so forth. So it's very very control oriented as far as the actual running of the captive. The management company, we don't do anything without written permission from the captive owner.
Excuse me, Jeff. A couple of questions have come in, if now's okay. Does the client have to buy insurance every year?
They don't have to buy insurance every year, and they can buy differing amounts of insurance every year. In other words, it's just like any other insurance policy. You buy it a year at a time, and you can change policy characteristics from year to year. If you choose not to buy insurance in your captive during a given year, then the captive still has those operational expenses. They still have to file a report each year. They still have to be audited and get an actuary review and so forth. So if you were going to have a year where you just had profits were down and you couldn't afford to buy the insurance, you'd probably still want to keep your captive running with the concept that the year following you'd hopefully be able to buy again. You could also buy a reduced amount of insurance to put premium in the captive for operating purposes.
Okay, is there a minimum amount of premium that's too small to make this work, or does it have to be 1.2? Is it all or nothing? Where's probably the break-even point, if you will?
Yeah, great question. It does not have to be 1.2, and in fact, we've just used that as an example here. Most of my clients do not put 1.2 away. They'll put varying amounts, and some of that's driven by the actual actuarial numbers that we come back with. The true break-even is probably about $250,000 in premium, but honestly, you wouldn't want to go through all of this just to break even. So our best advice to our clients is you need to be able to put about $500,000 a year away in premium, pay that, and you need to be able to see at least a couple of years ahead that looks likely that that's going to be the case for the next few years to really make this a working part of your financial structure.
Okay, great. Thank you.
one of the things that people are concerned about, and it really goes to your question, Damien, is I'm not going to be able to use the money in the captive immediately, and that's really true in a lot of ways. This goal is to put an emergency fund aside. This is your safe money. Some people talk about this as kind of a 401k without all the 401k rules. I don't personally, this is an insurance company, and insurance companies make money, and they are there for when bad events happen. But if you have to take money out, there are a number of ways to do that. You can pay reasonable salaries to yourself, to your children, to other business professionals who contribute to the captive. The captive can pay expenses associated with the captive. So the captive is required by law to have an annual board meeting in the state where it is licensed. Those expenses are typically borne by the captive. A number of my clients use that as a time to go to Utah, Montana, wherever it is, take a week off, and the captive pays for some of those expenses. Obviously, paying claims is a way to take money out, and you can distribute surplus or profit out of the captive in the event that you would need it. So there's a number of ways to get cash back out without liquidating the company. One of the things we often hear is this is another business. I don't have time for another business. Our job is to really make this a turnkey kind of setup, but even with all the things that we do to lift the management responsibilities off the shoulders of the owners really are going to spend between 2 and 4 days a year on this. If they will need to travel into the state where the captive's set up, have a board meeting. Again, most of my clients have a 2-hour board meeting and a 4-day weekend, but if that didn't work out, you'd still need to go there. So there is some time invested. I just got my own thinking on this is that if you can spend 2 or 3 days a year and run $1 million business, that's not a bad deal, however you slice it. And like I say, going to Montana isn't all that bad either. So why haven't I heard of this before? I think captives are becoming kind of more mainstream, and they've certainly since the 1950s, they've been very mainstream for Fortune 500 companies. But the IRS, because there was a major assault on captives, it just didn't make a lot of sense for a mid, small-sized business to take on the potential tax risks associated with captives. But that changed in 2002 when the safe harbor regs came along. So really these, at the level where most of us are dealing with, captives have really only been on the scene in any real way for about 10 or 12 years. We always get asked, well, this is so good, is the law going to change? And of course, no one can predict the future. Clearly, insurance is here to stay. Insurance companies, and this isn't licensed, a captive isn't licensed, insurance company is here to stay. 831B has been on the books for 25 years without modification, and it's instructive. There's a sister section that was enacted about the same time. It's 501c15, and what this says is that if you have an insurance company that has less than $600,000 a year in premium, and it is exempt from taxation. So some very bright guy in the Northeast said, well, this is pretty great, so he took about $30 million of appreciated stock and contributed that to his insurance company as capital, and then he ran his insurance company. He paid about $500,000 a year for a couple of years, and then he liquidated his stock. And of course, now he's exempt from the profits. The profits are exempt from taxation. And everyone, thought this was abusive. Rather than eliminate the 501c15 rule, however, what Congress did is they just modified it slightly to say that in the future, half the income for a 501c15 company had to come from the business of insurance. And so the point here is obviously that even in an abusive situation, Congress didn't do away with the rule. They amended it to more comply with what the point or the thought was. So I think that certainly in the foreseeable future, there's not going to be any significant changes to this rule, and so I think it is here to stay for a good long time. So I have now kind of gone through the key highlights here, and be happy to answer other questions if there are any.
Yeah, Jeff, got a couple that have come in. When is it too late, or what's the lead time required to set up a captive? Would I still have time in 2013, and would I get the full deduction for 2013?
And both excellent questions. One of the reasons that we're dealing with Montana is because they have a very fast turnaround. Some states will take 6 months after you submit the application to actually approve it. Montana will do it in a week or 10 days. It typically takes 4 to 6 weeks to do this. We have done it in as short as 3 weeks. So the answer is yes, there's still time to do this for 2013, but we need to move quickly if that is what your client wants to accomplish. Now, can you get the full deduction? And the answer is yes, but it depends on the kind of insurance coverage that you're writing. So remember, we talked about you can't insure risks that haven't happened, or better said, you can only insure risks that are in the future or that you don't know about but could happen. So again, taking my earthquake example, we can't write insurance for an earthquake that didn't happen yesterday. There's just no risk there. But if you have a business that perhaps has unknown liabilities, or you write the kind of policy that something could have happened bad maybe last January or February, but you don't know about it yet. For example, a kind of liability that would deal with the personal injury might comply with that, or a product liability case would fit with that. So if you write that kind of coverage, then we can write the coverage retroactively to the first of the year and charge a full premium for the year. So yes, there are ways to create an insurance policy where you can get the full premium deduction in this year, even though the company is formed late in the year.
Okay, great. Thanks, Jeff. Another interesting question's come in. How do we explain this to a client, or what are some ways in which we can explain it to a client?
That's also a great question. We have some materials that we can send you, a toolkit that kind of breaks this down and makes it simpler for you to approach a client on. But ultimately, I think our experience has been, if you'll bring us with you to meet with your client, or have a go-to-meeting, something like this with your client, we can kind of be the expert for you, and we're used to kind of explaining these things to clients, but we do have that information. If you want to contact me after this, we can quickly get you a toolkit that has some materials that you can use to approach your clients.
Jeff, good question. Is this only available to CPAs, or would other advisors be talking captive insurance to my clients?
No, it's not only available to CPAs, and yes, you should assume that other advisors are talking to your clients. So increasingly, we're seeing some very sophisticated financial planners talk about this with their clients. Also, some very forward-thinking insurance brokers are talking about captives with their large clients. Historically, insurance brokers haven't liked captives because captives don't pay insurance brokers. They don't need them. But again, very sophisticated brokers are now coming up with kind of, what's the right word, mixed solutions where the client takes a piece in their captive and reinsures a piece with a commercial company. So yes, you should expect that others are speaking to your clients. They may or may not be talking about the tax benefits, but they may be looking at other benefits.
Okay, so it doesn't look like there's any more questions that have come in. Jeff, any final thoughts? If you wouldn't mind just going to that last slide there as well. There we go. Any last thoughts in terms of the ideal client that this would work for, or the next steps for somebody that's interested in finding out more about captive?
I think the ideal client this works for, Damien, is the client who has a business that's spinning off an annual profit, so sufficient so that if they take between $500,000 and $1 million a year out of the profitability of the company, it's not going to significantly impact or adversely impact the operations of the company. That's where we should be looking primarily for clients. Then the next steps are, I think, again, we can get you some more material, but feel free to call or email me or contact us through the website, and we're here to back you up as the CPA as you talk about this very progressive planning process that your client can go through. So I think that probably the next thing is for us to have some face-to-face or individualized discussion about what your clients might need and how this might fit them.
Okay, perfect. Well, Jeff, thank you very much for your presentation today. I think it's fascinating, and one of the key things that I kept up or made a note on is what keeps your client up at night. And we're honestly, that's one of those questions or those magic wand type questions that we're all encouraged to ask. And not necessarily have the answer for it. But I think captive insurance could be one of those answers for what keeps somebody up at night. And I'm sure as soon as we ask that question, hopefully the floodgates will open from your clients. So folks, I will encourage you to check out Premium LLC, explore captive insurance, do a one-on-one, get the partners involved with a webinar with Jeff, and Jeff will probably bring in Mike from Milam Connect and Warner, who talked to us last week about tax planning strategies or the tax planning process. Anyone that needs CPE, please go to that URL. I will get the course notes to you, the links to you within an hour or so. So keep an eye out for that email. I'll also include Jeff's contact information, and this will be posted to our YouTube channel today as well. So ladies and gentlemen, thank you very much. Jeff, thank you for your time. And
thank you very much.
Absolutely, and my pleasure. So folks, have a wonderful day. Look forward to talking with you soon and seeing you online shortly. Have a wonderful afternoon.